So look at the markets. You can see stocks slipping on both sides of the border very slightly today. Our guest has raised his year-end S&P target from 6,600 to 7,000, partly because of the AI boom. But he warns that the U.S. economy is showing signs of weakness and could enter a recession. Let's get more from Jay Hatfield, founder, CEO, and portfolio manager at Infrastructure Capital Advisors. Jay, always great to see you. Thank you very much indeed.
Good morning, Andrew. Thanks for having me on.
Give us your out. You're feeling more bullish about stocks, partly because of the prospect of Fed cuts, interest rate cuts, and also this AI boom.
Absolutely. So we started out the year with the 6,600 target, which is 22 times next year's S&P earnings. So we just upgraded it one multiple point to reflect both lower long-term interest rates and AI momentum. We saw that with Oracle and Broadcom, because it's important to note that P multiples are inversely related to interest rates. So we really needed the 10-year to get close to our 4% target to justify a 23 multiple. And then next year we have a 7,700 target, and that's also just 23 times next year's, well, really the following year's earnings. So we're not expecting further multiple expansion.
Right, but you're looking that if we get to 7,000 by year end, that would put us on track for a 10% gain next year.
Right, but that just is the kind of the normal earnings growth kicking in. And investors should focus on that stocks go up in the long run because you have retained earnings, investment, and approximately a 10% growth in earnings over time, over year.
We'll get to some of your stock ideas later, but you are a keen observer of the monetary base, and you say it has stopped growing, or it's flat year over year. I think we have a chart. And that is often a sign of a slowing economy and possibly disinflation. Just remind us, what is the monetary base, Jay?
It's just the most narrow measure of the money supply. So it's just simply currency plus reserves. And that's really the most critical, because that's what the Federal Reserve or any central bank controls. And that's, in our models, what really drives inflation and GDP growth. And of course, it shows up in the real economy, because when the Fed restricts the money supply, interest rates go up and the housing market weakens, which is exactly what's happened. It's just that our housing market's more resilient after the great financial crisis. And plus, the AI boom is a unique tech boom in that it's affecting parts of the old economy. So it's kept us out of recession, but we can't afford to keep these ultra high Fed funds rates, which drive the 10-year to unsustainable levels.
So you are deeply critical of the Fed. So just you feel that interest rates are far too high right now, Jay?
Absolutely. So, and in fact, the money supply, of course, you can see from the inversion of the yield curve, but the money supply is a great indicator. It was flat for 3 years before the great financial crisis. So the Fed precipitated the great financial crisis. And it's one of three fundamental problems with the Fed is they don't use the money supply to forecast. And therefore, they're horrible forecasters of inflation and the economy. We saw that in 21 when they called for transitory inflation. So I would absolutely watch the money supply. If we get down to 3%, it should start growing normally. Normal growth is about 5%, which is nominal GDP growth.
Of course, we're not here to psychoanalyze Jay Powell, I guess, but do you think he got spooked? He underestimated inflation in 2021, and he's nervous now. He doesn't want to make the same mistake?
Absolutely. He listened to, and the Fed was really completely dominated by Keynesian economists. So they believe that inflation comes from the employment market and whether the economy is at full employment or not. So that's why he was so confident that it was going to come back down. And he ignored the fact that he increased the money supply by 70%. And of course, you can't ignore the money supply. If you could, then we wouldn't need federal taxes. Could just print money and pay for the federal government. So obviously you need to watch that. In third world countries, they have inflation of 100, 200% when they increase the money supply. So their models are completely broken. That's why we're not big fans right now, at least, of an independent Fed because we have an incompetent Fed. So you don't want those two combined. You don't want incompetence and independence.
Oh.
So they need to be reformed. Nobody's really talking about it. So it's going to be a concern even when the Republicans take over the Federal Reserve Board.